Good evening, everyone. Welcome back to the cost of capital session of financial management. I hope each and everyone is doing good, and we can resume from the same level of excitement, same level of energy where we left few days before on Wednesday, I believe, right? So I can see many people already geared up. So good evening, Ashok, Kiran, Harmisha, Mansi, Bhumika, and everyone else. Preeti, yes. So great, guys. Before we start, Harmisha, I saw your question with respect to one of the illustrations. If you see carefully in that solution, they have clearly mentioned hit and trial method, the calculation of IRR, illustration 10. And so that's why they have calculated. If you can try at your end, you may get, let's say, something around 11.5 plus or 12 point less than 12.5. So they have taken approximately 12%. So that's clearly mentioned as a hit and trial method. So don't worry about that as of now. Uh, so before we resume today's session, let us do a quick recapitulation of what we did on Wednesday, guys. So Wednesday, we talked about individual components of cost of debt, cost of equity, cost of preference shares. Within cost of equity, we discussed, I believe, five methods, right? And I told you guys that couple of methods are more important than others. That was your Gordon or dividend growth model and your capital asset pricing model as well, CAPM. So I believe where we had left the session was with respect to. So guys, there are some individual doubts I can see on the query panel. I want to just cover the remaining concept first towards the end. In case the time permits to tackle the individual queries, I would be more than happy. In case we fell short of time, I request you to email your queries. I just want to quickly resume on where we left as of now. That is your cost of equity. So there is one component within the equity. Remember, in the Gordon dividend model, we discussed that not entire amount is distributed as dividend. Something is returned as well, right? Something is returned as well. Ninad, that's absolutely okay. Tax saving is up to you, howsoever you want to calculate. Yeah, so I want to talk about retained earnings right now. And my first question of the evening to everyone is, does retained earning have a cost? I believe if you remember, one of the MCQs we discussed toward the end of the session, right? Towards the end of the session, which talked about of retained earnings having some kind of cost. Let's see who remembers this. Srinivasan has a very interesting question of changing CAPM model to include standard deviation, because a standard deviation would be a little tricky number to calculate for a pan industry. And we are talking about non-diversifiable risk over there, not for a company specific. Okay, Mamta says opportunity cost. Okay, what about others? I can repeat my question is, does the retained earnings also have any kind of cost? I absolutely agree with what Mamta said. It's like an opportunity cost, because we are saying that the shareholders did not get the same amount as dividend. It was retained in the business for the purpose of growth. But I believe we also included one term, right? When we were looking at that MCQ towards the end. So Mansi says opportunity cost. Everyone is opportunity cost. So can I say a kind of an explicit cost or an implicit cost? Implicit cost, right? That was the MCQ we did, right? Implicit cost. It's like implied cost. So let's resume our discussion of the day from cost of retained earnings, guys. Cost of retained earnings. I hope everyone can see my screen here. So generally speaking, the cost of retained earnings, of course, this is you guys are absolutely correct in terms of opportunity cost. That's the pretty much the golden word here. Why it's an opportunity cost? Because it's an amount in the form of dividend which is not distributed. It's dividend foregone. But my point here is that with respect to the cost of retained earnings, ideally it should be similar or same as cost of equity with respect to how it is computed, because it is part of the equity itself. Now, there could be a catch here when we talk about the cost of new equity or existing equity. So if I talk about cost of existing equity, of course, there is no flotation cost attached to it. But if I talk about a cost of new equity, in that case, the cost of equity could be higher than cost of retained earnings, because cost of retained earnings is the amount with the company which is retained in the organization. But cost of equity, or especially of a new equity, would be with respect to amount that is being issued, and some form of, let's say, flotation cost may have been incurred. So basically what we are trying to say here is the P would represent here as the net proceeds, as the net proceeds. So that is what, where we can talk about that, okay, the cost of new equity, if we are having a scenario where a company is issuing additional capital, in that case, we can conclude that, okay, cost of retained earnings may not be same as cost of equity. Why? Because cost of equity is higher than the cost of retained earnings in case of new equity. Interestingly, we can also argue that what if hypothetically there are no flotation cost even for the new equity? In that case, that's okay. In that case, we can say that cost of retained earnings is cost of equity. Our same conclusion stand true. However, coming to the reality, we talk about two aspects. One, there are not only the flotation cost, but think from an investor perspective, guys. Think from an investor perspective. Had they received those amount as a dividend, they would have paid some taxes also, maybe. So there could be taxes and flotation costs. You guys are all talking about from an opportunity cost perspective. So if the amount was distributed as a dividend, that would have been taxed. So what do you think, guys? Can I say that opportunity cost would be then net of tax? Yes or no? What do you think? Opportunity cost could be net of tax in that case, because whatever what would have been distributed to them, if let's say $100 is received by a shareholder and 30% is a tax rate, you are able to get only 70, rest 30 is gone in the tax, or 20 is gone in tax. What do you think? So if there are flotation cost, we will say that, okay, KR is equal to KE multiplied by 1 minus F. F is a flotation cost. And if there are tax as well, we will say, okay, 1 minus T. So we are talking about 1 minus F for the flotation cost, 1 minus T as a tax impact. Everyone doing good so far? So let me repeat two aspects here. Cost of retained earnings, my general rule could be that it is same as cost of equity. However, in case of new equity where there are flotation cost, we can say that cost of retained earnings is equal to KE net of tax and net of flotation cost. That's what the formula tells us. So make sure we know this aspect. Of course, we can discuss the same with the help of an example in front of our screen. And okay, let me quickly read a couple of queries here. Srinivasan says, retained earnings depends on dividend policy and growth prospects of the company. Absolutely, Srinivasan, I agree with you. But at the end of the day, there is an opportunity cost attached, right? I believe you also agree with that. Company has to decide, but from an expectation standpoint, there is an opportunity cost. That's what we are calculating. And we are not saying that, okay, you have to forcefully distribute this dividend. We never said that. We are saying that, okay, it is based on the cost of equity. Gunjan says flotation cost means, Gunjan, we discussed on Wednesday about flotation costs. Those are issuance related costs, right? Underwriting commission, brokerage, etc. Gajendra says, sir, tax will be there distributed. No. So we are talking about from an individual perspective. Gajendra, we are talking about personal tax on dividend. So whatever the income tax rules on dividend could be from a recipient perspective. I hope that makes sense, everyone. So let's do one thing. Let's take an illustration here. I guess you guys can read a small illustration on my screen. So face value of equity shares of a company is 10 rupees, whereas the current market price is 200 here. Now, company is going to start a new project. Now, that already raises my eyebrows, talking about a new project. That means some funding may have to be coming up from somewhere. Is planning to finance it partially by the new issue and partially by retained earnings. That means we are talking about some new capital would be issued and some is reinvested from the earnings which were retained in the business. Aman, I did not get your query. Is it all clear? Anything you wanted to ask? You are required to compute cost of equity shares as well as the cost of retained earnings. If issue price will be 190 per share and flotation cost is given 5, dividend at the end of the first year is expected to be 10 and growth rate is 5%. Interesting question. We are actually supposed to calculate cost of equity and cost of retained earnings. Now, if I were to talk about cost of retained earnings and cost of equity, what is that comes to my mind in terms of usage of denominator? On one hand, okay, in this case, I don't see anything with respect to the taxation being mentioned here for us. And if we talk about a general scenario that KR is equal to KE, KE we all learned is D1 upon P0 plus G. I guess that's what you guys learned the other day. Now the question here is that this could be a scenario for existing equity. This could be a scenario for existing equity. But what happens to the new equity then? What happens to the new equity? In the case of new equity, something comes into the picture in terms of the flotation cost. What do you think, guys? Do you agree with me? Everyone? So if we look at this particular illustration, if I were to ask you what is the cost of existing equity or retained earnings? Cost of existing equity or retained earnings? What do you think should be the answer? Let's see who answers that question. If we were to calculate cost of existing equity or cost of retained earnings, the main agenda here would be what would be my denominator's value. I believe in the existing equity, or when we are talking about cost of retained earnings, we may be able to use the current market price. But in the case of a new equity, we are forced to use the issue proceeds. Right? Harmisha says it will be same. Harmisha, that's okay, it will be same. But what I'm trying to ask is, let's say if I talk about the cost of equity, which is existing equity, that means I am talking about D1 upon P0. And what will be my D1 here? They have already given the dividend at the end of the first year is expected to be 10. So can I say 10 upon 200 plus 0.05? Can I say that? Cost of existing equity and retained earnings. That means, are we saying cost of retained earnings would be 10%? Yes, Armisha. That's absolutely correct. Yes, yes, yes. I saw your answer now. Good. Anusha says KE is 10%. Nitesh Ray say and Bhumika are saying that okay, it is 10% and 10.41. Can we take average? No, Akash, we are not talking average here. I think you're mixing up with the redeemable debentures and all, right? We are not doing any average of net proceeds and the market price. Because see, the point is, in case the new equity has to be issued, you need to understand and appreciate the fact that we are talking about issue proceeds would be always net of the any kind of a flotation cost. Now, in this case, they're specifically talking about in the illustration that issue price will be 190 and the flotation cost will be 5. So, Neelam, that's what we'll be doing. We will be doing the flotation cost. Let's see. If I'm talking about cost of equity, we are talking about new equity here. So that's what we are doing. 10 upon 190 minus 5. So 10 upon 185. And that's how we are calculating 10.41. And if we talk about KR, which is nothing but existing equity in this case, that's what you guys were answering as 10%. I think it's very, very evident in this case. And that's the concept I was trying to explain to you guys, is that cost of new equity is higher than cost of retained earnings. Guys, makes sense? Hence proved. This is the concept we are trying to discuss. Everyone okay till now, guys? Can I get a quick confirmation? Both the calculations are pretty much understandable, and I guess almost 7 or 8 students gave me absolutely correct answer. Armisha, starting with Nityashri, Bhumika, Kiran. So I think that is very, very good efforts. Everyone else doing good, guys? Okay. Now, if you talk about another example here, including the tax rate as well. Let's see what happens. Cost of equity of a company is 20%, rate of flotation cost is 5, and rate of personal income tax is 30%. So if this is the scenario, they have given you the cost of equity and they're asking you cost of retained earnings, then of course, as we discussed, we have to just multiply that by the net of taxation and the flotation cost. So basically, this 20% is initially multiplied by the 70%. And why net of flotation cost? Because if they reinvest somewhere, there could be a flotation cost coming into the picture. So it comes out to be a 13.3%. So that's my cost of retained earnings from an opportunity cost perspective. Okay, so Ashok has a question regarding to a financial. Ashok, I think for you, I have an advice that you should follow a diligent approach in terms of reading your study material and parallelly do some questions. Go step by step. Do not be too harsh. See, here in these sessions, you understand that we are taking up a topic, wrapping up in 2 3 sessions. Of course, we are doing some practice. We are explaining you guys concepts, but that doesn't mean that you guys don't have to go through your book and don't have to do practice. Of course, this is just an additional in terms of cementing that's happening for you guys. I would still suggest that if you guys have any kind of a conceptual gaps, make sure that you guys ensure to read your study material, guys. Okay, so a quick question for everyone, guys. Can you see that question at the bottom of the current slide? Cost of retained earnings in two scenarios, A and B. So the question is open for everyone. We are talking about the question at the bottom here, and you guys are supposed to give your answer with suffix or rather prefixing the a sub question number, whether you are answering for A or B. Yes, Harish, absolutely. So what should be the cost of retained earnings in scenario A? In scenario A, guys. Can I say that indirectly they're asking you cost of equity as per the dividend growth method model or CAPM model? I think that's what the key is. Mamta, that's a very, very good question answered by me. You are asking me retained earnings does not involve flotation cost, then it is why it is cost less than the cost of equity. Uh, Mamta, look at other way around that if the company is going for a new equity, they will be incurring a flotation cost, and that's why the cost of new equity is higher. Second, for cost of retained earnings, you are thinking from an investor perspective. If they will be receiving the same, they will be paying the tax and they have some opportunity cost. If they reinvest somewhere, then again the flotation cost could be an issue for them. That's why we are including that. Okay, Mary is giving me an answer of 15.5 and 15.5%, and Avinash also 15%. I think this question is simply asking about the cost of equity, I believe. So if you see the option number A, we are given DA, D0, P0, and G. But we have to use D1, right? So D1 would be 5 plus 5%, guys. 5 plus 5%, that is 5.25. So 5.25 upon 50 plus 5 would be approximately 15.5%. It seems correct to me. Those of you talking about 15.5. Some of you are giving me 10.5. I think you forgot to add G. Those of you are giving me answer as a 10.5. Let me remind you, the formula is D1 upon P0 plus G here. So make sure that you add the growth rate. Whereas for option number B, it was pretty straightforward. We are looking at RF plus beta into RM minus RF. That is the market risk premium. So scenario B seems to be 6 plus 1.3 into 10 minus 6. So I believe most of you got your answers correct. I think I could see 15.5 and 11.2 from Latesh, Surendra. We are getting Sudala and also Preeti and Mansi. Very nice, guys. Okay. So this kind of recaps our cost of equity as well. Uh, I would like to now talk about something at a grand stage. Can anyone guess what exactly needs to be talked about now? We have discussed each and every element of individual cost. We have talked about cost of equity. We have talked about cost of debt. We have talked about cost of preference shares. So what all we need to consider now? Remember where we started our discussion from Wednesday. We talk about cost of capital, why it is important, expectation, what the investors are expecting. But from organization perspective, if they were to use the cost of capital for in evaluating the investment decisions, or they have to decide a right optimum capital structure mix, you guys only told me that, sir, we have to uh, select that capital structure which gives us the minimum weighted average cost of capital. So I think, okay, Vijay Raghavan, taken your point. We'll use some darker colors, right? Okay. So we'll now move on to a weighted average cost of capital, guys. Because now it's a time to consolidate. And once we know this concept, we are doing a lot of practice today, guys. So I hope everyone is geared up and everyone is kind of pretty much on the high Josh, right? So overall cost of capital, what we are discussing right now from all sources of capital here, debt, preference shares, equity, including retained earnings. So what is very, very clearly evident is we cannot just add these up. We cannot just add these costs of capital. That would be a bigger mistake. Rather, we will apply the weights to each component depending on how much proportion do we have, or rather we are planning a debt or preferred stock or equity shares. And accordingly, then, if we apply the weights to the individual cost component, then we can add them up. That's what we are doing for a WACC. That is a weight of the debt into cost of debt, weight of the preference shares into cost of preference shares, and so on. Now, some people ask me this question, sir, that in some questions they have mentioned cost of debt and tax rate separately. Uh, I think you have to be very smart enough to identify whether it is an interest rate mentioned or a cost of post tax cost of debt, because cost of debt has to be net of tax, right? Now, the point here is it is well and pretty much easy to understand that, okay, hey, we need to take the weights, that's it. But now that the question is, what are these weights? What are these weights? Weights could be based on book value of the individual components or based on the market values as well. Of course, for you guys, the information given in the question will be helpful to guide you. What weights are you supposed to take, or are you supposed to calculate by both the weights? One important aspect is, and this is a question for everyone, when we say that, okay, let's take an example, ABC Limited company has a market share price of 2500. Now, my question is that 2500 market price of a share represents equity share, retained earnings, or both? Let's see. What do you say about it? If I'm saying that ABC Limited market price of the share is 2500, does that represent only equity share, or it represents retained earnings, or it represents both? This is a conceptual question. I want to see if everyone is on the same page here. Let's see who answers this first. Ruturaj says it represents both. What about others? What about others, guys? I think uh, most of the students, including Viswajit, Sahil, Harish, Ninad, and Ikshi Kumar, everyone is trying to tell me that it represents both, including Harmisha as well. Some of the students are thinking of equity share. Guys, think it that way. If I quickly draw a small balance sheet here, we are talking about equity. We are talking about within the equity, we can have equity share capital, we can have preference, we can have debt. But I believe you should understand that retained earnings are part of the equity here. Retained earnings are part of the equity. So what we need to understand here is that if we are taking market value of the equity, in that case, if market value is given, we have to proportion them between the book values of equity and retained earnings in case we have to calculate KR and KE. In case KR and KE has to be calculated and we are taking market value as a weight, we have to apportion that. Don't worry, we will discuss this. See, the reason is very, very simple, that there is no separate market for retained earnings. As in, equity is not only the original face value or the original share capital, but it also includes the growth, that is in the form of the reinvested earnings. So when we talk about the book value of the equity includes the retained earnings as well. That's the point here, right? So when we are talking about no separate market, it includes both the paid up capital and retained earnings. So what we're looking at is that it could be also a scenario that yes, cost of retained earnings and cost of equity could be different due to flotation cost. But the most important factor is when we are taking market value, then you have to apportion them. When you are taking book value, doesn't matter because book values may you will have the value of the share capital retained earnings anyhow. So let's do one thing. Let me give you an example of this wherein you will understand this point. So cost of equity of a company is 10.41, whereas a retained earnings is 10%. Someone can assume that this is very much similar to the numbers we already saw. There are 50,000 shares of 10 each, and retained earnings given is 15 lakhs. Market price is given as 50 Ks. Now, can anyone tell me what is the total market value of the equity here? What is the total market value of the equity? I believe we're about 50 per share. 50 into 50,000. Can I say 25 lakhs? And if this is including or inclusive of retained earnings, don't you think this can be split up into what is the market value in proportion to the equity shares? And what is the market value that needs to be allocated to the retained earnings? That's the agenda here. Whereas, what is my book values? What is my book values, guys? My book value in this case is, we're talking about as an equity of 5 lakhs and retained earnings is given to us 15. So can I say that 25 lakhs market value, which it's given to us, needs to be bifurcated in 50s to 15 or what, sorry, 5 is to 15 or what should be my ratio here? 5 is to 15, I think 1 is to 3. So that means 1 by 4th is equity and 3 by 4th is retained earnings. And that's how we are writing these values 6,25,000 and 18,75,000. And we use that for the cost of capital. We multiply these weights. We multiply these weights with the individual cost of capital also to calculate this. Someone may argue that, okay, we actually need Do we actually need to bifurcate? Even if you don't have bifurcated the market value, our weighted average cost of capital would have been same. That's okay. But we still need to understand, because this is a question which only talks about these two components. Where we are talking about some additional decision making, where additional capital needs to be raised, then you need to understand if there is in the books equity is there, retained earnings there, and they're asking you to take the market value as the weights, you should know how the market value gets bifurcated into equity and retained earnings. Everyone clear of this example, guys? Can you please confirm if everyone is clear of this example? What's going on here? Everyone okay? How did we come up with 6 lakh 25 and 18 lakh 75? Agenda was to divide the 25 lakhs value in the ratio of 1 is to 3. What is 1 is to 3? 1 is to 3 is nothing but book values, book value ratio. So it'd be great if you guys confirm this is pretty much okay with all of you. Okay, if this is crystal clear, thanks Harmisha very much, and everyone else, Mamta, Srinivas and Kiran. Time for another illustration for us. And now I want everyone to be on their toes. We have to calculate a WCC here using a book value as well and market value as well. We're talking about two scenarios. Okay. So the capital structure of a company consists of 5 lakhs debentures with market price as 105, 5 lakh preference shares with market price of 110. Equity shares also is given along with the market price. Some additional information is given with respect to debentures. This is redeemable, preference shares redeemable, and equity shares information is given with respect to the flotation cost and market price. The next year expected dividend is also given with annual growth of 5%. Firm has practice of paying all the earnings in the form of dividend. Corporate tax rate is 30%. Use YTM method. Now look at this, guys. This is what I was talking about the other day. YTM method to calculate the cost of debentures and preference shares. Now that can involve a little bit of a time or practice, of course, at first shot. You guys can do the practice or calculations at pace at your ease later on maybe. I don't want you guys to start calculating the NPV using IRR right now. It will take much longer time. But I would like to guide you. Question coming from Janice, how to calculate cost of capital. Janice, that's what we are discussing now. This question is also a good recap of what we did on Wednesday, right? Because we are for calculating WSCC, aren't we supposed to anyways calculate individual cost of capital, guys? You guys agree with me? So, anyways, we are doing a recap of what we did on Wednesday, right? A little bit practice of Wednesday stuff, right? So, let's start our discussion. Now, first step, it looks to be for debentures and equity, preference shares. I think what is most easy here to calculate, I think straightforward seems to be equity to me. Can anyone tell me what is the cost of equity? I think that is something you guys can do quickly here. Cost of equity. Based on the information, it believe the formula we can use is D1 upon P0 plus G. I don't think this is a CAPM model question. D1 is given to us or no? D1 seems to be given to us. 1. P0, in this case, they have given us the flotation cost and market price. So net proceeds is 24 minus 4, right? And growth rate of 0.05. So what is the cost of equity? I think cost of equity is coming very, very straightforward. 1 by 20 plus 0.05. It seems 10% to me. 10% to me. And we will, everyone is okay with cost of equity, guys? Everyone okay there? Very nice. Okay. Now we move on to do a hit and trial method, YTM, for cost of debt and equity. Let's do that together. I think 10% of cost of equity, I guess everyone is okay here. Harmisha, I think you need to check something. I don't know if by any chance did you do 1 plus 5%? Just double check, because they had given the expected dividend of 1 rupees, right? I hope you have noted that. So we talk about cost of equity as 10%. But now we are discussing a cost of debt using the YTM. Remember, we discussed as per the YTM, we are looking at the IRR method. IRR method, we talk about two random rates. This is again a repetition, guys, with one as a lower rate, NPV positive, and one is NPV negative at a higher rate. Uh, and I have to check that illustration because right now I'm in the middle of some other question. So I request everyone to please concentrate here. Kiran says, please explain difference between YTM and CAPM. Kiran, it depends on information. In the capital asset pricing model, you are talking about the security market line where you are calculating the cost of equity based on risk free rate of return and the market risk premium, incorporating the systematic risk. Whereas in the case of the dividend growth model, we are talking about the dividends and earnings are growing at a constant rate, and we use a different formula altogether, right? So everyone remembers the YTM method, guys. My question is, if we are looking at a debenture here of 100 rupees and we are looking at cash flows, we are looking at the cash flows. Can anyone tell me how come initial cash flow is 100.8? How come the initial cash flow is 100.8 here? And retained earnings formula, that is anyways a retained earnings formula, right? So we are talking about cost of equity. Cost of equity will be always found out using either the CAPM or dividend growth model, not that formula. That is for cost of retained earnings anyhow. So I just concentrate on this question right now. Uh, everyone needs to answer the question I asked. Why did I use initial cash flow as 100.8 instead of 100? Or is there any flotation cost mentioned? Flotation cost is mentioned as 4%. Then why not 96? So this is something which I want you guys to wonder, is the market price is 105. So 105 minus 4% would be 100.8. 105 minus 4%. Absolutely correct, Sudala Srinivasan. Very nice. So everyone okay here? 100.8. And then since we are talking about a 10% coupon rate, whereas they have given the tax rate of 30%, so we are talking about 10 into 1 minus 0.3. That is 7 is my interest net of tax. So you can see 1 to 10 years is 7, and at the 10th year, 100. And remember, we discussed that day that we reverse the values because for IRR, initial value is outflow and the remain later on there are inflows for IRR. So we swap the signs from an investor perspective, from an expectation perspective. We swap the sign 100 to minus 100 and these minus 7 and minus 100 to plus. So what I did was right now you can concentrate on the screen. I picked at a rate of 5%, guys. What did I get in terms of NPV? Net present value, I got 14.64 by using a discounting rate of 5%. I told you that we need two NPVs. One is negative and other is positive. So if using the first random rate, my NPV is positive, mathematically we all agreed and we know that the second rate would be higher rate. Now it has to be a random rate. You could take 8%, you could take 9%, you could take 10%. I took 7% here. And look at that. Luckily, I was just on the margin here. Luckily, I was on margin. If it was also positive, I would have done that exercise once more. I would have taken 8%, 9%, whatever. But this thing tells me if NPV at the rate of 5% is 14.64 and NPV at the rate of 7% is minus 0.8, and YTM method is the is basically a method of calculating the cost of debt or cost of preference shares using a YTM method, which tells us this is that IRR at which the future cash flows equal the initial value. And at the IRR, NPV is zero. You will discuss this in detail in investment decisions, in capital budgeting. Hamisha, mostly they will be giving you the the present value annuity factors or an abstract or a section of a table where you can refer them. Otherwise, it's mathematical. I told you 1 divided by 1.1 plus r. You can do m plus n number of times and look at the grand total. You can practice, and that can absolutely be pretty comfortable. But I don't want you to do that right now, because I want we can use this time to practice more variety of questions than going on to the mechanics of the calculation. I hope everyone appreciates that. Uh, so guys, everyone understood my point? Latesh, random rate. Latesh is a very, 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 very good point. Latesh says, how could we guess 5%? Latesh, you could have taken 10% now. Latesh, if you would have taken 10% now, your value would have been negative. Then automatically second rate you would be taking as a lower rate. This is what I mentioned now. You have to discuss, you have to see that, okay, what is your first rate, random rate NPVs? If it is positive, take a higher rate. If it is a negative, it's take a lower rate. Janice, you can double check that later, please. I am pretty sure there has to be some catch. We are taking year 1 to 10, by the way. Year 1 to 10. You are saying year 1 to 8. We are taking year 1 to 10. I believe we are talking about 10 years, right? 10-year maturity. I think that's where you missed out. Yes. Preeti, I absolutely agree with you. And that's why I'm saying that, just assume that, okay, you know the present value factors and quickly check this. And why it is time consuming? Because it is initial stages. Once you practice 3 or 4 questions, it will be less time consuming. I can tell you. Coming back to my concept, guys, everyone okay here that yield to maturity method of calculating cost of debt of preference shares is telling us that cost of equity or cost of preference shares or cost of debt is that rate at which the discounted value of the future cash flows is the current value. That means it is that internal rate of return. IRR is the rate at which NPV is zero. Having said that, if IRR is that rate at which NPV is zero, one rate is giving me 14.64, rate is giving me minus 0.8, which is closer to zero? Obviously 7%. Hence, if we apply our formula that we learned the other day, this formula of IRR, and put the values, that means we're talking about lower rate is what? 5, 14.64 NPV at lower rate, minus 0.8 multiplied by 7 minus 5. So if we apply this, we are getting 6.9. That means as we expected this number to be closer to 7%, because NPV was closer to zero. So between 5 and 7, the answer had to be closer to 7%. This is the logic. This is the concept. Yes, yes, Eximer. That's what we are doing here. Because if we were to selling the debentures, it will be at the market value, right? Or if it is not at the market value, you need to also understand, the rate could be different, right? If you are not taking 10% rate, then automatically it could be premium or discount. Mamta says it means if positive value come with a given discounting factor, use some other rate to get a negative. Yes, But you need to understand, Namta, what will be the second rate? If the first value is positive, guys, please understand, how do you discount? Let me kill that. I think many people are not comfortable in discounting yet. In your class 9th or 10th, you guys had learned a formula. A is equal to P into 1 plus R to the power N. Do you guys remember that? Compound interest. Compound interest. This was the formula we learned. Everyone learned there. Everyone okay here, guys? Now, the same formula, if I can just swap the sides, P is equal to A into 1 plus R to the power N. That's the P stands for principal. Those days, I can say P is a present value. P is a present value. I'm just using the same formula. So that means if my first value in terms of NPV is positive, and how would I have discounted? I've discounted by multiplying by this. So for reaching a negative value, my R needs to be increased. This is simple mathematics, guys. You need to practice. No one is going to teach. No one is going to teach mathematics, but you need to practice. Karan, thanks for acknowledging. Sushil. Yes, Bharti. Thanks a lot. Yes. So similarly, guys, now everyone understood that we calculated a 6.9 as a cost of debt. Let's come to cost of preference shares. What would be the initial outflow for the preference shares, guys? Initial cash flow, let me put it that way. What would be the initial cash flow for preference shares? Same logic. For the preference shares, it's 110 market prices given. Preeti, that's okay, but don't take too much white. Don't take like 10 and 20%. Your answer will not be as accurate then. So 110 is my market value for preference shares. What is the flotation cost given to us for preference shares? 2%. So 110 minus 2% should be 107.8. So let's go to cost of preference shares now using YTM. Initial cash flow is 107.8. It was 5% preference shares, so 5 dividend. There is no tax reduction here for preference shares. And again, I have tried. Now look at this, guys. Look at this. So a lot of people were asking this question. Again, I took a random 5% rate. What I'm getting in result is negative present value. Negative. For getting a positive present value, I'm forced to take a lower rate now. I have to take a lower rate. So second NPV, I calculated using 3%, and hence I got a positive rate here. So at 3% is 9.26, at 5% is 7.80. Applying the same formula, we're getting 4.09 here. Srinivasan says if flotation cost is not considered in the debt, then the cost of debt will be higher than equity. You're talking about generally, okay, let me not even talk about numbers, Srinivasan. You tell me in a, let's ignore the calculation part of it. Although we could see that, okay, 6.9% is lower than the cost of equity of 10%. Even when the numbers show this, think it that way, Srinivasan, that since my interest on debentures is always tax deductible, ideally cost of debt should be less. Carrying a cost of debt should be less, but maybe more, they will be more risky because you will have to pay the principal and interest, whatever may happen. That's why you understand the financial leverage, right? Debt equity ratio. Karan, no, for YTM, I would say you can use random rate, but in case they given the question to use some specific rates, that's there is no harm. But I best believe in YTM you have to use your own random rates. So everyone okay here, guys, for calculating the preference, the cost of preference share is 4.09. Onus is on you guys. You guys can later on practice these questions, guys. And there are more questions in your past year papers, RTPs. YTM method, to do it better, there are only 3 shortcuts. Anyone interested in knowing those 3 shortcuts? To get a command on the YTM method? How many of you want to know the 3 shortcuts? for getting the YTM method absolutely clear and get some confidence on YTM method. You guys want to know the three shortcuts? If you want to know the three shortcuts, don't kill me after that. The three shortcuts are practice, practice, and practice. So if you practice 3 times, it would be better. I am sure some people want to kill me. Okay, Eximer says, please clarify one more time why taking market value is less quotation cost. Why not? Eximer, the point here is what we are talking about here is that you are talking about a same rate, right? Same rate. So when we're talking about the issuing more, we are talking about a market price when it is given to you. But when we're talking about difference in the rates, that's where the premium or discount also comes into the picture. This is the point I explained earlier. Okay. Okay, guys. Now I'm talking about a weighted average cost of capital. So we let us kind of quickly summarize. Cost of equity was how much? 10%. Cost of debt we calculated as 6.9, and cost of preference shares we are talking about 4.09. So we have option of calculating book value as a weight, right? We are talking about book values given to us. We can go back to the question. 5 lakhs, 5 lakhs, 10 lakhs. So 5 by 20, 5 by 20, 10 by 20. So we talk about 5 by 20, 5 by 20, 10 by 20. So we get 7.75% here. Everyone okay here? I think book value is straightforward. You're just multiplying the individual cost with the weights. Even the market value, taking the weights is not a problem here anyhow. Even if you take the market values, that's not a problem because in the bracket they have given you the market value, right? So market value for the debentures is 5,25,000, reference 550, and equity seems to be 24 lakhs, right? 10 lakhs with a market price of 24. So seems 24 lakhs. So what does the total amount comes up to? 525, 550, 24 lakhs. Total is 34.75. So you can take these ratios to multiply and you get a 8.57 is a market value as a weight here. WACC for market value is slightly higher because of the higher market value in terms of equity. You can see that, right? Everyone clear, guys? I think this is a good example, which is not only the practice of YTA method. If you honestly ask me, what does this example do? Is just make you practice YTA method. WACC is okay as long as I'm sure you guys agree with me. Once you guys are comfortable in calculating individual components, WACC should not be problem. And individual components, I think, I believe there are two aspects you all need to be careful. And this comment I am making based on your inputs. One, YTA method, many of you are not yet comfortable, so you need to practice. Two, some people are making mistake in the dividend growth model between D0 and D1, which is what you need to be careful. If they are giving you the next expected dividend, do not multiply by 1 plus G. These are the two things I'm observing right now based on the responses here. Guys, now I would like to talk about a very, very important concept. I would say from a concept standpoint, I would say this is more of a last concept here. And then we have a lot of practice coming up our way. So let's see this concept as well. So this concept is about a marginal cost of capital. Marginal cost of capital. Now, overall, if we need to understand the word marginal here, means there was a status quo and something got changed. And we are talking about what got changed. So marginal cost of capital is the cost of raising an additional rupee of capital. That means, are we saying that the marginal cost of capital would entice you to issue new capital in the market? And if that is the case, probably the flotation cost will come to the picture. See, why we are discussing this concept, first of all. The background of this particular concept is nothing but called as expansion. If a company goes into expansion or takes up new projects, what is the first thing company needs to consider, guys? What is the first thing companies needs to consider? Let me hear it from you guys. If a company needs to go for expansion or a new project, what is the first thing they need to think? They need to plan. Come on, guys. I'm sure you guys can do it. I believe the first thing is, what is the first thing? I think you guys are all future chartered accountants. Paisa. Where does the paisa come from, right? Everyone is like giving me an answer, right? Sources of funds, additional funds, Mansi, Nityashri. Where do you get the funds from? Now, what could be the options? If you guys are giving me this answer, you should also know the resorts, right? Where do we go? Where do we go for the additional funds? Can I say first look at your pockets or then approach outside? Very nice, very nice. Akash, Srinivasan, Gajendra, Preeti, Iksimar, very nice. Ninad, everyone. Nikita and Bharti, you guys are absolutely spot on. But my question is, maybe first we can look our own pockets from a company standpoint. What could be my first preference? What could be the company's own pockets? Retain earnings. Time for those. I'm sure in India, when we talk about expansions, or let's say a family wants to buy some new jewelry, first they check their own pockets, right? I'm not sure what is the terminology used, but I've heard that, the mothers of the house, the ladies, they will find money in some secret pockets always, right? I'm pretty sure you guys agree with me. So retain earnings. So there is nothing secret in terms of the companies. We're talking about the retain earnings. Retain earnings is definitely first. But let's say if retain earnings are not sufficient, then you will go for a raising of finance. Now that could be from equity or debt. But we know that if it talks about equity, there is a chance that you are incurring a higher cost of capital because of flotation cost. Yes, Ninad, retain earnings, bank shares, debentures is giving you all the option. Very nice. Kiran, cost of additional, yes. Very nice, Gajendra. Gajendra says after considering retain earnings, look for issue of share capital or debt. Very nice. Sankaran, absolutely true. So what I'm trying to say, guys, you need to answer this question actually till the time we are not going outside for additional finance. Can I say my WACC doesn't change because cost of retained earnings still then is equal to cost of equity? What do you think, guys? Yes or no? However, if as soon as I go for a additional source of capital, the point where I am incurring or issuing a new equity, suddenly, marginally, the WACC gets increased marginally. Why? Because you will be talking about, you have learned today itself that the cost of new equity could be higher because of the flotation cost. So this is something very, very interesting for us. So what we need to understand is, first is to calculate the marginal cost of capital, the intended financing proportion should be applied as weights to marginal component. So what I'm trying to say is, till the point you are not going for additional capital, till that point, can I say that the marginal cost of capital would be nothing but WACC? Can we conclude that? Till the time we are not going for to raise additional capital, till that point, marginal cost of capital is WACC, nothing else, because it's not changing. It's not changing for us. But when we are raising funds, and we are not only raising capital, we are raising in the proportional manner, that is the components cost remains unchanged, there would be no difference between average cost of capital and the marginal cost of capital. What we are trying to say here is, as soon as we will be raising new equity, our cost of capital will change accordingly WACC. But at the same time, we need to ensure that most of the times company wants to prefer to retain the pattern of sourcing of the funds. Let's say debt is to equity for a particular company is 3 is to 2. Even for the new project or after the new project, they want to carry the same proportion 3 is to 2. So that means not only they might be looking for raising additional equity, but they may also want to raise some additional debt to keep the same promotion. Who knows? So let's do one thing, guys. To understand this concept a little better, what we can do here is we can look at a comprehensive example here. We can look at a comprehensive example to understand marginal cost of capital and do more practice as a consequence. So let me quickly change my screen. Let me know if you guys can see a question wherein we all can plan to do a bit of dhamaka with Dhamaka Limited here. Everyone can see this question here. So let's see what is the requirement, what are the facts given to us here together. So here we are talking about a capital structure given to us on 31st March. Vivek has a question, how company give benefits to the shareholder for holding retained earnings? Vivek, what do you think? Why the retained earnings are held? I think that's what we are discussing, right? Expansion, growth. You remember that the shareholder doesn't only get a return in form of dividends, but also in the terms of appreciation. We discussed this already. Okay, so what is the share capital given, the capital structure right now? And the company has a market price of 23.6. Next year, next year, the dividend per share is 50% of year 2019 EPS. And following is the trend of EPS for the preceding 10 years, which is expected to continue in future. So this is an important line. It says which is expected to continue in future. This is important for us to know. It is expected to continue. And make sure that we are aware of what year we are talking about here, right? So till the 2019, they are talking about EPS is 2.36. Can you see some kind of a trend in the EPS, guys? Some kind of trend? I think I can see a trend. It is going from 1.1 to 1.1, 1.1 to 1.21, and so on. I see a trend that the EPS every year is increasing by 10%. 10% is what we are trying to see here. Okay. The company issued new debentures carrying 16% rate of interest, and the market price of debenture is 96. The preference share is 9.2 with annual dividend of 1.1 were also issued. The company is in 50% bracket here. So we need to calculate some aspects. We have to calculate cost of new debt, cost of new preference shares, new equity share. So we also have to calculate marginal cost of capital when no new shares are issued. Look at the second question, guys. The question number B says marginal cost of capital when no new equity shares are issued. That means we are calculating WACC, nothing else. So we'll come to option number C and D in a while. Let's target option number A first. Cost after tax of cost of new debt, guys. Who will tell me the cost of new debt? Cost of new debt here. Cost of new debt. They're talking about 16% rate of return. Interest, I think its tax rate is this much. Market rate is given 96. What's that we are looking at here? 8 upon 96, guys. What's that? Can anyone tell me? 8 upon 96, everyone is giving me 8.33%. Bhumika, Harmisha, everyone is telling me 8.33%. Similarly, can you guys tell me the share capital or other cost of new preference shares here? Cost of new preference shares. Thankfully, we are not even looking at YTM right now. We have discussed one question already. We're talking about 1.1 upon 9.2. Is there a tax reduction here? Is there a tax reduction? I don't think so. I'm getting 11.96, or if you want to round off, we can use 12% here. New equity shares, assuming new equity comes from retained earnings. Now, this is interesting for us. This one is interesting. So, my point is, we are saying D1 upon P0 plus G, right? For the equity shares, we need to understand that it's D1 upon P0 plus G. What information do we have here? They're giving you next year dividend per share is 50% of 2019 EPS. So let's do that. If I multiply 50%, am I getting 1.18, guys? So is 1.18 is D1 for us? Yes or no? I think 1.18 is a dividend for us. But that's what the question tells us. That means we can simply do 1.18 upon, they have given us the price, right? What is that? The company's market price of the share is 23.6 plus G 10%. So we are looking at 1.18 divided by 23.6. So it gives me 15%, guys. Cost of equity looks to be 15%. Can anyone double check here? I think I'm already getting a 15% answer from many students. I think this was pretty much a cakewalk, calculating the three cost of capital sources. And we are also talking about a scenario where the next question incidentally talks about calculating marginal cost of capital when no new shares are issued. We have already discussed, if there are no new shares are issued, marginal cost of capital is nothing but WACC. Srinivasan has an interesting point, seeing the cost of debt, ROC is less than the debt. Srinivasan, analysis is a good part, but right now we need not go there, as in, like, see, it could be related to the point of, as I said, maintaining a proportion, right? Financial leverage to a point could be healthy. Sometimes there are strategic factors that comes into the picture. Okay, so looking at WACC, guys, what should be my WACC in this case? Do we have a proportion here or there given to us? I guess yes. The proportion is given to us. We can look at the capital structure. So we are talking about 3 by 20, 1 by 20, and 16 by 20. So 3 by 20 into 8.33, right? That's what we calculated. I'm just using of a rounding number for preference shares. So who will tell me what is the WACC, guys? What is the total of this? 3 by 20 into 8.33. We're talking about, are we all getting 13.85%? Are we all getting 13.85% here? Everyone doing good? Hmm. Misha, can you just double check? I want some confirmation from others. Is it 13.85, everyone? Perfect. Very nice. Okay, so in that case, now is the very, very important time, guys. We need to understand quickly the requirement of the question C and D. Question number C says, determine the amount that can be spent for capital investment before the new ordinary shares must be sold, assuming that retained earnings for the next year's investment are 50% of 2019. So, one thing is for sure, if we are looking at an additional issue, what would be the maximum amount that could be spent here? We are talking about issue of or use of retained earnings. I'm pretty sure that's what everyone understands here. The requirement of the question, guys, please try to understand. The amount that can be spent for capital investment before new ordinary shares must be sold, assuming that retained earning for next year's investment are 50% of 2019. So let's try to understand what is the retained earnings. So they've given us 2.36 as a EPS, right? But have they given us the 50% as a dividend? That means, can I say a retained earnings will be 2.36 into 50%? And number of shares is 10,000, guys. So can I say retained earnings is 11,800 based on the information given to us? 11,800. So before I look for additional capital or I need additional capital, initially, can I say that it's 11,800 is the retained earnings I need to use? I hope everyone was with me. And mind you that I am talking about capital ratio or a capital mix, which tells me 3 is to 1 is to 16, which is given to us as a debt is to preference share is to equity shares. If I were to invest X amount, let's assume that the project or additional investment is X. Can I say 80% of X is retained earnings? 11,800. Are you getting me, guys? Hence, we are looking at X is equal to 11,800 divided by 80%. That means up to the expansion of 14,750, up to the expansion of 14,750, there is no new shares have to be issued. Retained earnings are there. Remaining portion would obviously be coming from additional debt or preference shares, but at least new equity may not be sold. The requirement is that what amount that can be spent for capital investment before new shares can be issued. So what we need to understand here is, that we are looking at 11,800 retained earnings divided by 80%. How did I get 80%? Because I'm following a capital structure which says a weight of 3 is to 1 by 16. 3 is to 1 is to 16. So 80% is my equity. If retained earnings is 11,800, That is 80% of the total investment. So I am spending 14,750. I can assume or safely say that 11,800 is coming from the retained earnings, and the remaining could be your debentures and preference shares. But the requirement is what is the amount that could be spent here. So that we have calculated, guys, as a 14,750. And this is an important point for everyone to understand, right? Because not only that, we need to understand that, okay, the company is planning to maintain the same capital proportion. Also, we need to understand that, whatever the additional investment is, will be beyond this point. So can I say beyond 14,750, my cost of equity will increase, hence WACC will increase? Yes or no? Do you guys agree on this? Beyond 14,750, the cost of equity will increase and WACC will increase. Everyone okay here? Guys, can you please confirm? This is our understanding here. And if that's the case, guys, come on, need a quick confirmation. Everyone is with me on this page till this point, 14,750. Everyone okay here? Very nice. Thanks, Sahil. Thanks, Bhumika. Thanks, Preeti. More confirmations, better it is. What about Nishit, Sahil? Sahil has confirmed. What about uh, Harsimran, Harmisha? Everyone doing good? Now, look at the requirement of the last point. Compute the marginal cost of capital when funds exceeds the amount calculated in C, assuming new equity is issued at 20. That's what I said, right? As soon as I need, as soon as I need more than 14,750, what you need is new equity. And for new equity, we may need to calculate a new capital. They are asking you to calculate the marginal cost of capital. So that means that they're actually asking you new WACC. But for me, it's not as easy. First, I have to calculate the new cost of equity, guys. What will be my new cost of equity now? Remember, my formula was T1 upon P0 plus G. We are talking about 1.18. We have already discussed this. We are using the same numbers. What goes change is the denominator. Denominator mein we are using 20 and G was 10%, right? So we are looking at 1 divided by 1.8. Sorry, 1.18 divided by 20. And we are talking about 15.9%, I believe. What was my original cost of equity, guys? What is my original cost of equity? Can anyone tell me? I think it was 15%, right? So that means, can I conclude that cost of equity has increased from 15% to 15.9%? That's what I'm expecting. Hence, the WACC or marginal cost of capital, the new one, will accordingly change. Will accordingly change. 3 by 20 into 8.33 plus 1 by 20 into 12 plus 16 by 20 into 15.9. In the absence of the information, we are not even changing the cost of the preference or debentures. One can argue said that there could be a change in them also. What about the new preference? What about the new debt? Mind you, we have already calculated the cost of new debt and new preferences. Refer to question number A. We have already calculated cost of new debt and cost of new preferences. Don't worry. So whatever it is, I believe we are getting 14.57 here. So marginal. So abhi tak what was happening was My cost of capital or a weighted average cost of capital was 13.85, and suddenly a new equity is issued, and this has shot up from earlier. It was, I think you guys told me, right? What was my earlier capital? Everyone told me 13.85, right? So from 13.85, it has increased to 14.57. So just to recapitulate, guys, this concept is based on particular concept is based on a simple point of marginal cost of capital. As long as you guys are investing or reinvesting your retained earnings, your marginal cost of capital will be same as WACC. But as soon as you reach or beyond that point, you need additional issue of equity, your cost of equity will increase. Hence, your WACC will increase. The only interesting point was in point number C, where we had to decide what amount could be, you know, invested in the project without going for new issues. Now, for that, we needed to ensure that we know one thing, that companies are following the same investment, same capital structure, 3 is to 1 is to 16. So we calculated the retained earnings as 11,800, but then we knew that the retained earnings or the equity is actually 80%. So 11,800 divided by 80% is what is giving us 14,750. I think that was the crucial point of this particular question. So I'm just kind of recapitulating the entire question once. I think Gunjan asked that, a couple of Mamta and a couple of other students also asked that. I hope that helps. It's a very, very good question. I think I personally like this concept in terms of understanding it. It kind of expands your understanding about the cost of capital, marginal cost of capital. So it's very, very important here. Sahil, I believe we are talking about, it was mentioned there, right? In 2019, I believe. Right? 2019, I believe. That's what mentioned in the question. Harish, no. Harish is saying with the issue of new equity may also impact the total weight. No. So as we said, right, we are talking about, we are issuing all the capital in the same proportion. Right? Look at the third point. When a firm raises funds in a proportional manner. Proportional manner. Eximmer says if additional funds were raised from debt, that will be weight on. Eximmer, that's what I said. For the last point, we are just using the same cost of debt because that was anyways a new debt, right? That was anyways a new debt. Had the question told us something else, some additional information to again change the cost of debt, which is not the case, of course, we would have incorporated the same. If you see point number A, it was the cost of new debt we calculate, cost of the new preferences we already calculated. And assuming that it was the same proportion, that's why we are using the same proportion. This is exactly what I answered to Harish's question as well. Okay. Perfect. So Srinivasan is asking me a NPV based question. NPV from the project is positive with increased marginal cost. We'll talk about NPV scenarios, capital investment, investment decisions. Srinivasan, Sahil says yes, but another example, if 30%, you can do that practice, Sahil. That's your homework. If you want to change the proportion, the question has to state that, right? Okay, folks, great, amazing. I just realized it's almost 7:25. I guess some of you might need a break. What lies on the other side, guys? We set 3 shortcuts to success: practice, practice, practice. So the one of those shortcuts, more practice is coming your way. And we can talk about the more questions after the break, yeah, guys. So let's take a quick 10 minutes break, everyone, and see you on the other side with few more questions to practice, some objective and some detail both, guys. See you after the break. Okay, guys, so welcome back after the break. I guess everyone is pretty much refreshed, much needed break for all of us after a good knowledge absorbing part. Let's resume our session with some MCQs as well, guys. What do you think? So let's talk about the first question here. What do you think? What should be the answer? Which of the following cost capital required to adjust tax? I think very easy one. Just to give you guys a little bit of a refresher, or I think some easy questions should also have their way. So what do you think? I think only one cost of capital is giving you tax benefit. Srinivasan says in Gordon's model for growth, we can use return on equity in the place of R. Uh, you can use that. I believe why you're asking is because of the question in the study material as well, where we are using the R the same, because we are taking that as a growth, right? Okay, so everyone is talking about question one as answer C, right? That's absolutely correct. Cost of debentures. And then we are talking about question number two. Some details are provided to us, and the requirement is to calculate WACC. WACC. What do you think, guys? I think cost of equity is given to us 16%. The harder part is given. What will be the cost of debentures here? The cost of debentures, we are talking about 15% rate, but 15 minus 15 into 1 minus 0.3, so it should be 10.5%. 12% is a preference shares. So this is a practice, guys, which can help you to calculate something quick. Something quick. And the proportion is anyways with you 50, 15, and 35. So 50%, 15%, 35%. And your accordingly your capital your cost of capitals are 16%, 12%, and 10.5%. So if you multiply that, everyone is getting 13.8, 13 point something, guys. 13.48 to be precise. Is everyone getting this number? Yes or no? But everyone else? Super. Okay, guys. So let's move on to a couple of more questions here. And you need to give your question number along with the answer, whatever you're getting. So question number three, what do you think? Which of the following is an implicit cost of increasing proportion of debt of a company? Hmm. I think this is a very interesting logical question here. Yes, Exemer, Harish, that was absolutely correct. I think somehow the answers reflected on my screen a little late. So I want everyone to give me an answer for question number three now. I think unanimously, I'm getting answer as very different answers actually. It started with B, Then Gajendra says A, and Iximer says it could be A or C. Price earning ratio of the company would increase. I think in absence of information, can we say that actually? Because we're talking about two components, right? Price also and earnings also. P ratio is a component of two aspects, right? But I think for sure, what I believe is, don't you think if we increase the debt, we are talking about using the financial leverage more and more, don't you think the company will become more risky? The risk is increasing, and hence we are talking about the equity shares would demand more return in that perspective. I think that would be more direct answer. I think I got option number C from Eximer, from Srinivasan, from Natesh. Others were slightly confused between A and B, I guess. The answer should be C. And the logic I'm explaining you is clear cut, that you guys are supposed to understand this way, that okay, the company becomes more risky with more debt on their balance sheet. Okay, I think the question number fourth, I think some people are even answering question number fourth already. I got few answers as option number B for question number fourth. I think question number fourth is straightforward. Preference dividend upon the net proceeds. So 18 upon 118, I think that is 15.25 percentage. I think you guys are spot on. Those of you have calculated question number fourth as well. Very nice. Bhumika, Pooja, Nishit, and Nithashri. Okay, guys. So the presentation we are using here, I'm sure you guys would have seen that was downloaded, uploaded couple of days, in fact, before Wednesday, and you guys would be having more questions on that. I will try to cover some of those questions in the class. Some questions are there for your practice also. But before I go to more questions, I would like to discuss a case study with you guys, a kind of a different pattern that would be reflected for you guys. I'm sure you guys are aware that a kind of a case study with a bit of details given to you guys, wherein you would be having 5 MCQs based on the case study. Everyone ready for that kind of a question as well? So let's share my screen now. I hope you guys can see my screen right now. I'm trying to zoom in a bit. Please confirm if you guys can see the details. So we are looking at a very, very interesting case study here, which talks about a company called Paradise Renewables. Everyone can see, right? So what they are doing here is, it's a renewable energy company specializing in solar panel manufacturing and installation. The company is considering expanding its operation by investing in a new solar farm project. As part of the decision making process, the financial management team, that means you guys, need to determine appropriate cost of capital, and they're giving you some information from their financial information, financial, rather statements, right? So equity share capital 10 lakh, debt outstanding 5 lakh at 6% interest, preferred stock outstanding as 2 lakhs, cost of equity is 12%, cost of preferred share is 8%, and corporate tax rate is 25%. So what we're talking about is, based on this information, there is a bit of questions coming up your way. If you wish, you guys can take a snapshot of this piece of information. There is a request of zooming in more. I can keep on zooming, but then less information would be visible. So based on this information, we are coming up with few MCQs for you guys. And my request is to everyone to, you guys just can take a snapshot of this information. Take a snapshot from your mobile or whatever, so that you guys can then concentrate on each MCQ based on this. Everyone ready for the action here? So let's see what is the first MCQ with us. What shall be the cost of debt that is used for calculation of WACC? Some quick answers should be coming up your way, I believe. Some questions can take time, some questions could be quicker. What shall be the cost of debt that is used for calculation of WACC here? Is it 6%, 4.5, 8%, or 10%? I think immediate answer was, I think everyone is like, that is a easy slice of cake. Everyone is like thinking that, okay, they have given us the interest of 6% here. So 6 into 1 minus 0.25. So everyone is like B option 4.5. That's very, very nice. I hope everyone is on the same page. Let's look at, very nice, guys. Couple of answers were option number A, guys. Please double check. I think you guys have to do the tax shield. And that is why the questions can be slightly tricky, that you will have a lot of options that can induce you into your wrong option. 6% interest hai, but there is a tax shield also. 4.5. So let's go to question number 2. What is the weighted average cost for Paradise? Weighted average cost. You have some options. I requested you guys to take a snapshot earlier of the information. I think you have cost of equity with you, cost of preference, cost of debt you calculated as part of the first question. You have to tell me what is the WACC. Hmm. Let's see what is the response for question number 2 here. Amazing. I've already got first response coming in for question number 2. I don't want to reveal the answer yet, but Anusha is the first one who has given me a response. Very nice, Anusha. Harish as well coming up with an answer here. I think till now I've got 4 answers, and thankfully all the answers seem to be united with each other. No worries, Srinivasan. Okay, I think a lot of people are giving me a different answer altogether. 2.336 is not even an option here. Preeti and Latesh, we may need to double check something. I think majority of the students are giving me answer as option number C. Let's see if we can quickly pull around that together. So we have a total capital 10 plus 5 plus 2 as 17 lakhs. So 10 by 17 into 12%, or you can see 0.12 plus 5 by 17 into 0.045. That's what we calculated in question number 1. And 2 by 17 into 0.08. So I think this is how you are supposed to do a simple calculation here. The question is not tricky. It's just that I think you guys need to be uh, familiarized with the format of the questions. That's what I want. We will have more practice in other sessions. Also, we'll try to incorporate at least one question of a case study, wherein based off the one set of information, you are attacking 5 different questions. So it is very important that you guys are familiarizing yourself. So I think uh, people are telling me it's 9.32. So in that case, my answer becomes option number C. And that means the majority or the janta is correct. Very nice. Very nice, guys. Those of you gave the correct answer. Let's move on to a question, next question based on the same information. Now, the company is moving on to consider a new solar farm project with an additional, I think this is something which we already have the information, right? They were anyways considering the new solar farm project, but we never knew how come the funding will come. And now they're saying additional initial investment of 3 lakhs, and the project is to be financed by additional debt with interest rate of 8%. So in this case, I think some of you were asking me about what about the different capital mix. Now, in this case, question is clearly telling you that we are talking about additional 3 lakhs, but we are talking about entire amount coming with the additional debt of 8%. What shall be the new WACC for the company? Mind you, I can just give you a hint here. Guys, please mention the question number if before you are answering, right? I think some of you are just giving me alphabets, right? A, B, C, D. And just now I got an answer as C. Is it for question number 3 or another question? Let me know. Just prefix the question number, guys. Okay. In this case, what's happening is I already had for question number 3, we already had, I think, equity worth 15 lakhs. How much is the equity we had, guys? We can quickly go back and check. Sorry, 10 lakhs. Debt as 5 lakhs and preferred stock as 2 lakhs. So we have equity of 10 lakhs. We have existing debt of 5 lakhs. We have a new debt coming in for 3 lakhs, and my preference remains at 2. So I can see from 17, my total capital now is 20 lakhs. My total capital becomes 20 lakhs. So make sure we kind of take that into account. And we all have calculated cost of equity that will remain same. Existing debt. What was the existing debt, guys? Cost of existing debt. What was the cost of equity which was given to us? So cost of equity is given to us is 12%. Existing debt you all had calculated as 4.5%. Cost of equity is 12%. But the point here is that there is a cost of new debt coming into picture. The rate is 8%. So I believe the new debt is 6% here for us. New debt is 6%. And cost of preference remains the same. What we have already used earlier, 8% as well. So you know what to be done. 10 by 20, 5 by 20. You can just simply multiply these. And you can tell me what is your new WACC, guys. New WACC. Based on the working we have done. Are we saying everyone unanimously giving me an answer as 8.8%? That is option number A. I would like to wait for more people here. Exemer, are you sure about that option or not sure? I think your answer is seemingly slightly different. Others are giving me 8.8%, which seems to be option number A. Can everyone check, guys, please? People who are getting different answers, those of students can actually double check. All okay, guys? Hmm. Thanks, Anusha, Vivek, Bhumika, Nikita, Gajendra, everyone, Nishit. Nice. Okay. We can move now to the question number fourth. If Paradise Renewables corporate tax rate increases from 25% to 30%, how would this affect the company's cost of debt, guys? How would this affect the company's cost of debt? Let's say your responses now. I got one answer, guys. Give me the answer in terms of like 4A, 4B, 4C. This is the fourth question we are doing. Hmm. So if the corporate tax rate is increasing, is this going to impact my cost of debt? I think unanimously everyone is giving me 4B. The cost of debt would decrease. I think I'm pretty much bound to agree with you guys because we all know cost of debt is interest into 1 minus T. That is section we use in the numerator. So if my tax rate goes up, my cost will go down. So it will be meaning, more tax shield. More tax shield means lesser cost. Very nice, guys. I'm pretty glad that you guys are all thinking on the same page. Okay, let's look at last question of this case study. Paradise Renewables decides to issue additional equity to finance the expansion project. How would this impact company's WACC? What would be the impact on WACC now? I think this is something we have discussed today. So should be also not that tricky. We have discussed the same logic between the marginal cost of capital as well. So you can use the same logic. What's going to happen for question number 5? Is it going to increase, decrease, or is it's not going to impact? What would happen? I think unanimous response coming in, guys. Very, very nice. Everyone is saying that, okay, additional equity would means always the new equity cost is always higher because of the flotation cost as well. And hence the impact will be WACC will be increasing. Guys, very, very rightly selected because anyways, we all understand that the cost of equity or equity is the most expensive source because A, the dividends are not tax deductible and B, from an expectations of the shareholders perspective. Very, very nice. So it will increase. It will increase, guys. Absolutely correct. So, guys, does this give you a good flavor about what kind of questions we are lining up in terms of the new curriculum, in terms of the new style, where you guys would be posed up with a kind of a case study like this, and it could be slightly more trickier, of course, as we move on. As in the other topics, we may have a little bit more case study, but this is a very, very good experience for everyone. That based on a case study, you guys are attacking multiple questions here, right? So let's go back to our usual stuff. As I said, we will be having a lot of practice, practice questions. So let me select one practice question actually from what we have. Just give me a second. Okay. So you guys can see a question on your screen right now. The company wants to raise additional finance of 5 crores in the next year. The company expects to retain 1 crore earning next year, and further details are given as below. The amount will be raised by equity and debt in the ratio of 3:1. Additional issue of equity shares will result in price per share being fixed at 25. Debt capital raised by way of term loan will cost 10% for the first 75 lakhs, 12% for the next uh, for the next 50 lakhs. And then net expected dividend is given as 2 per share. And the dividend is expected to grow at the rate of 5%. So there are four questions here. One is determine the amount of equity and debt for raising additional finance. That should be very, very interesting. Determine the post-tax average cost of additional debt, cost of retained earnings and equity, and then overall WACC. It's a very, very good comprehensive question. Examer, apart from the doubts we are handling here in the class, in case later on during the practice you have any questions, you can always email us at the fm-ICAI email ID, right? Okay. So, what is the amount of equity and debt, guys? Who will tell this? Question is for you guys. What is the amount of equity and debt? Examer says 37 lakhs 50,000 for equity. Interesting. Or are you saying 37 lakh 50,000 or 3 crores, whatever you're saying? Just double check that. I think you're talking about 3 crores 75 lakhs, if I'm not wrong. Maybe a zero here and there. Just double check. This is a very, very interesting question. The first one is a very, very interesting question because why? Because many students get confused. And I think I'm getting two responses. I'm getting 3.75, 1.25. I'm also getting 3 and 1. I'm also getting 3 and 1 as an answer here. Now, in this case, let's see how do we attack this. That we have to raise additional capital of 5 crores. Company expects to retain 1 crore earning next year. And they have to raise the equity and debt as 3:1. So if I have to raise 5 crores, we are talking about 3:1. That means we are talking about 3.75 CR and 1.25 CR. This is what the majority of the answers are giving. Majority of the students are giving this answer. But I somehow feel that it is not the complete answer. It's not the complete answer. Everyone is saying 3.75 is 1.25 is this. The question is amount of equity and debt for raising additional finance. So I think my answer would be 3.75. 1 CR is already retained earnings. So you are raising 2.75 CR for equity. And for 1.25 debt, you should mention specifically that we are talking about 75 lakhs at 10% and 50 lakh at 12%. Am I correct, guys? Or am I correct? Is this a complete context? I think maybe you guys were stopped at 3.75 and 1.25. I just expanded on from there because you have to specify, what exact amount of equity you will be raising, right? Raising additional finance. The word was raising. So 3.75 was incomplete. You're about 2.75 and 1.25. 3.75 includes your 1.25. I hope this makes sense to all of you. Yes, Bhumika, absolutely correct. Now, the second question is very easy. They're asking you determine the post-tax average cost of additional debt. So they're only talking about debt here, but the word is additional debt, and there is a word called average cost. Are they giving us a tax rate here? Yes, tax rate is given 25%, thankfully. So that means we can actually do an average calculation. Now, of course, in terms of the two debts, Preeti did not understand. Preeti, what happened? 5 CR is what you need in total, right? Your ratio is given 3:1. So 3/4 of 5 is 3.75, 1 by 4 of 5 is 1.25. 3.75 is the equity you need, but you already have 1 CR retained earnings. So you can go for additional 2.75 now. Okay, for option number B, we know that the debt is 10% and 12%, but mind you, there is a tax benefit also. So we can say effectively it is 7.5 and this is 9%, right? Post tax. Post tax. So if we want to say average cost and the ratio is 75 by 50. So what is the ratio? 3 is to 2. 3 is to 2. So can I say 3 by 5 into 7.5% plus 2 by 5 into 9%? What are we getting, guys? What are we getting here? Can anyone tell me? 3 divided by 5 into 7.5. I think I'm getting 8.1%. Is everyone getting 8.1 for option number B? Yes, please double check. Vivek, I think you need to double check. What about others? Harmisha, you need to double check, I guess. I think now I'm getting more answers as 8.1. Perfect. I think third one is your cup of tea. Determine the cost of retained earnings and cost of equity. So who will tell me the cost of retained earnings and cost of equity in this case? Are we talking about the new equity or no? If you're not talking about, Bhumika says, please repeat B part. Bhumika and B, the requirement is post-tax average cost of additional debt. So first we need to understand what is my additional debt. Additional debt is 1.25 CR, right? Additional debt is 1.25 CR as we calculate in option number A. But if you have to calculate average cost now, we have to average in that proportion of the debt only. So cost of the 75 lakhs was 10%, but net of tax would be 7.5. Cost of the next 50 lakhs is 12%, but net of tax it will be 9% because 25% is a tax saving. So you can apportion the 7.59 and 9 in 3 to 2 ratio because you are talking about total 1.25 CR at different rates. Bhumika, I hope that is clear. And now I'm on to the third question, and I believe I request you guys to answer for the third one. Third one says determine the cost of retained earnings and cost of equity. I believe if there is no new equity here coming up, is there a new equity coming up? Yes, there is a new equity coming up. But are we talking about a different cost of equity or a same cost of equity or retained earnings? That's the question here. I think we discussed equity includes the retained earnings, 3.75 includes 1.25. And we are talking about cost of retained earnings and cost of equity here. Share price is being fixed at 25 and net expected dividend on equity is 2 per share. Dividend is expected to grow at 5%. So what do we do? What should be my cost of equity here? I want you guys to be very, very careful. Some people are telling me cost of equity and retained earnings is 13%. Okay. Some people are saying 8.4. Eximmer, have you added growth rate? I guess again, some people are missing growth rate, guys. Make sure that you don't miss the growth rate part, please. Don't miss the growth rate part. So my formula is D1 upon P0 plus G. Now the word here is net and not next. They mention net expected dividend, not next. So 2 into 1.05 is what we are looking at. So 2.1 upon 25 plus 0.05. I am getting 13.4%, guys, which happens to be matching with some people. एक से मर net लिखा है, net. It's not next. You're talking about D1. D1, 13.4%. 13.4%, which what I am getting, I think it is matching with few answers here, but I'm not sure if you guys actually took 2.1 or 2. I think Vivek, Latesh, you guys can double check. Yeah, I think everyone now agreed with me. Exemer, I hope it is clear now. All okay, guys, till this point? Gajendra says, how come 2 into 1.05? Gajendra, I'm again repeating. If you read the fourth point, they're saying net expected dividend is 2 per share. So they're not talking about D1. They're not talking about the next expected dividend. They're talking about the net expected dividend. That too is what is expecting now, but we're talking about in a year later. That is 2 plus 5%. So those who are done with 13.4, can you quickly do option number D now? So I think very, very interesting is we know from option number A that we are talking about a ratio of 3 to 1. We know point number 1 is 8.1%. Point number C gives us 13.4%. That's what we have already calculated. And now we are talking about overall weighted average cost of additional finance after tax. I think question number 4 becomes a cup of tea here for everyone. You know the 3 is to 1 ratio. You have to just multiply by 8.1 and 13.4. So let me know what is your WACC. Because now you have done your half your homework in option number B and C already. Vivek says, Vivek says that we are talking about 3 by 4 into 13.4 plus 1 by 4 into 8.1. It gives you as 12.075%, which is what I'm getting from a couple of students more. And you guys can absolutely check your answers, guys. I'm pretty much sure that we are trying to pick some variety of questions here, which should be helping you to grasp your command. Today, we have done a lot of practice on different aspects. We have talked about YTM method. We have talked about marginal cost of capital. We did a big question on that. Now we are talking about expansion projects in a case study and another question. So I think it's a very, very good participation from all of you. I hope you acknowledge that, this is what you guys should achieve when you guys are practicing questions at your end. So that, you guys are trying to do a little bit of a practice and, make sure that you guys try to do a little bit of a versatile questions. Okay, let's try to move to another question here then, which is a very, very interesting question. Let's move to the next question here, which is on my screen right now. Navya Corporation has a capital structure of 40% debt and 60% equity. The company is presently considering several alternative investment proposals costing less than 20 lakhs. The corporation always raises the required funds without disturbing its present debt equity ratio. And they're giving you cost of debt and equity for different project cost ranges or slabs. Assuming the tax rate 50%, calculate the cost of capital of two projects X and Y, whose fund requirements are 6.5 and 14 lakhs respectively. So they're giving you different aspects here. Now, my point here is we are looking at two projects which may fall under different ranges here. You guys can see here that in this case, X falls under the third slab and project Y falls under fourth slab. I hope everyone agree with me on this. Yes or no? Yes, everyone with me on this? X falls under the third slab and Y falls under fourth slab. And one thing is very much given to us is that capital structure is 40% debt and equity. 40% debt and 60% equity is given to us. Now, here we need to understand one thing is that we may know a WACC different for different slabs. That means we may have a different WACC for this particular slab, third and fourth. So whatever WACC you calculate on these two, that should be your answer for project X and Y. Yes or no? Preeti, the PPT is already uploaded. I had uploaded below before Wednesday's class. Please download. I think most of you guys have already seen, right? Can you guys please confirm? You guys should have got the PPT a day before the Wednesday's session already, guys. I think some people are confirming that. Yeah. So what we need to do here is what we can quickly check is that what is the different cost of capital. Mind you, the cost of debt is given to us 10%, 11%, 12%, and so on. Please don't take a mistake of just using this entirely. This is cost of debt and not after tax cost of debt. Mind you, they are giving you a tax rate of 50%. They are giving you a tax rate of 50%. So that means what we need to consider is after tax cost of debt. So that means what we are seeing here is in this case, we can calculate the cost of debt after tax is exactly half of what is given to us. Cost of equity we can take as is 12, 13, 14, and 14.5. And for each of the four slabs, you can see that weighted average cost of capital is calculated based on the ratio of 4 is to 6. 4 is to 6. I think it's a very, very straightforward interpretation because we are talking about that cost remains same in between these ranges. So if my project is, let's say, 6 lakhs, 8 lakhs, 9 lakhs, so that means project X is 6.5 lakhs, which falls under range third, wherein my cost of capital is coming out to be 10.8%. So that's my answer. Similarly, project Y of 14 lakhs, that falls under the last range, last slab. There, my cost of capital is coming as 11.3. We have done a lot of calculation already. That's why I'm just quickly showing you the workings, how to approach this kind of a question, guys. Is this clear to everyone? The first part of the question is clear to everyone. What is the cost of capital of project X and Y here? The only thing I needed to tell you, guys, was that in terms of the cost of debt, make sure that you take the tax impact as well. Right? Everyone okay? The second part of the question, though, is also very, very interesting. If a project is expected to give after tax return of 10%, determine under what conditions it would be acceptable. It is expected to give a tax return of 10%. Now, my point is, if you're talking about return of 10%, would you accept a project only if a return is more than the cost? Yes or no? That's what will be my criteria here. Is everyone with me on this? Point number 2 analysis. Everyone doing good here? Is point number 2 analysis is good, guys? Now that means if I'm saying that return should be more than the cost, let's quickly look at what is my cost in all the four slabs. I can see 9.2, 10, 10.8, or 11.3. I think if we're talking about a 10% return, you'd be more than happy if the project is costing within 2 lakhs. At max, at max, we can accept at break even. So if the project is coming up with the investment of below 5 lakhs, we can take that up. But above 5 lakhs, my cost is increasing, right? 10.8 and 11.3, that will not be attractive for us. Guys, everyone doing good? Any doubts for the second part? Because the return is given to us 10%. So we have to be ensuring that, okay, that project cost is less than the return here. Perfect. Super, guys. Now, with last 10 minutes approaching to our session, let me quickly talk about one more question, and then there are a couple of more questions in this presentation which you guys can attack later on for your practice later on. Let's quickly approach to the last question here. Part of it we have already done in earlier sense, in earlier examples, but let's see if you guys can answer that quickly with me. Mogambo Limited. Whenever I see this question, Mogambo Limited, one question comes to my mind, right? I don't know if you guys have wondered. Everyone has watched a movie in which Mogambo was a villain. What was the name of the movie? Anyone remembers the name of the movie in which we had a villain called Mogambo? And many people see that, okay, if we are talking about Mogambo, the question which comes to many critics' mind is, was Mogambo married? In that movie, they never showed, Mogambo's wife. Was Mogambo married? No one knows. But I remember someone telling me that, you know, uh, the movie name was Mr. India, and he used to repeat a dialogue called Mogambo Khushua, Mogambo Khushua. So he must be bachelor, right? So that's the interpretation, very interesting interpretation. But I'm pretty sure I intentionally asked that question because almost 10 students replied Mr. India, and all of them are telling me that financial management is very tricky, cost of capital is very tricky. You can remember Mr. India's villain name, then I'm sure you can do very well in cost of capital, very well in financial management. I'm pretty sure. Just kidding, guys. Okay, let's jump on to Mogambo Limited question. So, Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. It has 2 lakhs 10,000 in form of retained earnings available for investment purposes, and further details are given here. So, we're talking about debt equity mix is 30/70. Cost of debt up to 180 is 10%, and beyond 180 is 16%. Do you agree this is exactly the same what we did just now? How many of you agree with me? If I look at the question number one, what is the pattern for raising additional finance? You need 10 lakhs. They are giving you 3 is to 7. 3 lakhs is debt, 7 lakhs is equity, but they already have 210 in the retained earnings. So 210 is there for retained earnings. That means we are talking about a 4,90,000 of new equity. New equity. Even for 3 lakh debt, I would say 1,80,000 is at 10%, and remaining 120, I think we're talking about two rates, right? At 16%. Everyone okay, guys? I don't want to go into the details of this question. This is very, very similar to what we already did, but I want you guys to be on the same page with me. This is pretty much similar question which we have already done today, right? And that's why we always say that, Mogambo khush hua, because he knew how to solve the question, right? So I think rest is history then for us. Because if you look at question number B, post-tax average cost of additional debt. So if I talk about post-tax average cost, what are we looking at? We need 1.8 and 1.2. that is 3:2 ratio, the tax rate is given to us as 50%. So these are effectively net of tax 5% and 8%, guys. The the debt cost. So 3 by 5 into 5% plus 2 by 5 into 8% is what we are looking at in terms of the average cost of debt. 3 by 5 into 5%, that is 3%. And then we are looking at another 3.2, which gives us a 16.2 in totality. So, man, absolutely correct. So that is cost of debt is kind of 6.2% here. Examer says, please repeat capital mix pattern. Examer, the capital mix pattern is given here, na 30-70 debt equity. So debt is 3 lakhs and equity 7 lakhs. But equity mein na 7 lakhs out of 7 lakhs, you already have 2 lakhs 10,000 as a retained earnings. So 490 is what we are looking at here. 490. Okay. Is the additional equity. So what is the cost of equity, guys? Cost of equity would be D1 upon P0 plus G. What is D1 for us? Dividend payout is 50%, right? So in this question, they have given us an EPS and a dividend payout. So dividend D0 is 2, growth is 10%. So D1 becomes 2.2. 2.2 upon 44 plus 0.1. It seems cost of equity is 15%, guys. So that means we are looking at cost of debt as 6.2, cost of equity as 15%, and third part is definitely your cup of tea, which you guys can easily calculate. Your 70 and 30 or 3:7 ratio, whatever, you can easily calculate the WACC. I think that was fantabulous. I guess we take care of so many concepts, so many practice questions today. I'm pretty sure that you guys benefited out of the session. Before I end the session, I just want to quickly show you that there are few questions in this presentation which you guys can later on practice on your own. One question is this one, which is ABC Limited. We're talking about ABC Limited. And another question is towards the end, I believe, which is with respect to a Mangalam Limited. So I'm giving you two questions as part of your homework, additional practice, so that you guys are in good shape. Of course, you guys can go back and pick more questions from your past year papers. Make sure that you guys are familiarized with the new curriculum, new style of questions, especially the one we discussed today. That is a case study based on which we had multiple questions. We'll try to cover more questions there, guys. And I hope you enjoyed today's sessions. I absolutely humbly thank you guys from core of my heart with wonderful, participation. The students like you keeps us going. And it's always amazing. I hope you guys also enjoyed this session. We would expect same two-way participation going on in all the sessions. This is it from me for cost of capital. I would be meeting you again in almost couple of weeks time towards the end of this month for investment decisions. And then we had towards March, we will be working together in working capital management, guys. So wishing you all best of luck in your studies. Make sure you work hard, and ever you feel tired, ever you feel frustrated, always remember my words, guys. Whenever you are absolutely tired, you see that, okay, it's a long journey. Always remember one line, that there is always light at the end of the tunnel, and that would always keep you going. So that is it, guys. Have a very good evening, good night, best of luck, keep on working hard. See you soon, guys. Cheers. Bye bye. Take care. Good night.